Greetings, everyone. Welcome to this special edition of Cutting Through the Noise. I'm Samantha Geyer, Marketing and Communications Manager at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little about Tony and our firm. Tony is a partner and chief investment officer at SignatureFD. He chairs our investment committee and represents the firm at various industry events. Tony's a contributor on numerous broadcasts, including NASDAQ Trade Talks and TD Ameritrade Network, and his commentary has also been featured in articles from the Wall Street Journal, Barron's, the Financial Times, the Bond Buyer, CNN Business, and other prominent industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. It's what we call net worthwhile. With that, I'll turn it over to Tony to get us started.
Thanks a lot, Samantha, and thank you everybody for joining today. We're calling this kind of a special edition because we're going to take a look back at some of the trends that we saw in 2023. And then we're going to look ahead to 2024 and give maybe a little bit of an outlook for 2024 and how we're thinking about things as we head into next year. So we'll really just start with this. In 2023, stocks and the economy, they largely surprised the upside throughout the year. And that is certainly not where sentiment was heading into the year. So we're going to talk about what people were saying as we moved into 2023 and where the surprises were. And we'll do that by framing the backdrop that we saw and that we have now that ended up making the consensus wrong. And we'll discuss whether those conditions are likely to be present in 2024. And then finally, we'll ask some key questions, especially as we kind of turn to our outlook component that we'll be looking at as we begin the new year. So with that, we'll get right into it. This is going to be fairly chart heavy, but we're going to try to walk through these things. And remember, we're very data driven in what we do. And that's why we kind of showcase these charts and the data points for y'all. And what we have right here to kick it off is this is a chart that shows economic sentiment at the beginning of 2023. Now, the average professional economist predicted about a 45% chance of recession going into the year. And that's the highest level since at least 1970 when the data began. Now, just because they believed the probability of recession was high, that doesn't mean they were necessarily wrong. And they did leave over a 50% chance that we wouldn't have a recession. However, the tone was quite negative from an economic perspective heading into the year. And the issue was that their bearish tone on the economy really funneled through to the stock market sentiment as well. And we can see that here. Bloomberg began collecting Wall Street strategist projections for stocks back in 2000. And you can see here that analysts always predicted an up year from 2000 through 2022. And the exception to that trend was actually heading into 2023. This time last year, strategists believed that stocks were in for a loss this year. Instead, stocks have had a strong rally. And we're reminded that the market usually does what it needs to in order to prove the majority wrong. So when we think about how the consensus was positioned heading into 2023, you think about it as really for economic turbulence and a bear market. And instead, what we got was a pretty strong economy and higher stocks on the year. Now, economists don't just pull these numbers out of thin air. They had really good reason to believe that recession risks were high. So here, what we're showing is the Conference Board's index of leading economic indicators. And what you can see is that it peaked early in 2022, and it's been falling ever since. Now, historically, when those leading economic indicators turn lower, it's only a matter of time before the economy itself is in a recession. Now, the issue in this cycle is that the data that comprises the leading indicators is potentially not as relevant today. It overweights manufacturing data, and we need to remember that this is a service-based economy, not really a manufacturing-based economy. And it includes consumer sentiment, which has been atrocious this year, even as inflation tends to has come down. But remember that high levels of prices tend to wreak havoc on consumer attitudes. So consumer sentiments remain depressed throughout the year, and things like the yield curve have not been great signals this time around. So that's all data that goes into leading economic indicators, and for one reason or another has not been a great barometer of economic activity. Now, what we're showing here is the Citigroup Economic Surprise Index throughout 2023. Now, what this measures is whether data that's coming in is exceeding or less than what the consensus estimates were before the data was released. Now, readings above zero, that means that the data is coming in better than expectations. And we can see that really since February, the data is very consistently beaten expectations. And when I look at this Citigroup index in other years, I can say that 2023 is one of the very best years I've seen for consistently beating economic expectations. So that is what has happened. Now let's take a little bit of a look at why that's happened and to try to get a sense of whether it can continue. So here we're showing excess months of savings that the consumer has on hand. Now note that consumers have been draining their extra pandemic savings. That's been going on since Q3 of 2021. But as of today, the top 25% of savers still have about 6 to 7 months of extra savings. And the bottom 75% of savers have about 4 to 5 months of extra savings. So what we can say is that excessive pandemic savings is normalizing, but it's not yet fully exhausted as we turn to 2024. Now, perhaps more encouraging for a more sustainable run in consumer spending is that disposable income has gone up at a faster rate than spending has in every quarter this year. So in this chart, the green bars show the growth rate in income. The black bars show the growth rate in spending. Note that indeed in 2021 and 2022, the consumer was having to dip into their savings to support their spending growth. But throughout this year, incomes have increased faster than spending. And that is a trend that we think that's far more sustainable than using excess savings to support their expenditures. So this trend of higher real incomes, this has not yet shown signs of slowing down. So that's potentially good news as we head into 2024. Now, this chart here attempts to quantify the effects of higher income, higher interest rates, and inflation in major categories like rent, food, and energy. So the green bars here are income growth. The yellow bars are the effect of higher interest rates. And the blue bars are the inflation effects. Now, the first two columns are for the bottom 80% of the income distribution. Note that rising incomes made them slightly better off in 2022, but softer inflation and stabilization in rates while incomes kept growing made this cohort significantly better off in 2023. Now, for the top 20%, higher rates were a bigger drag in 2022 because it depressed the value of their stock and bond portfolios. But now, higher rates are a positive as cash is earning an attractive rate. So I know that consumer sentiment remains quite depressed, but spending levels continue to rise. And much of that is because the hard data has improved. Now, another major moat that economists underestimated was the tightness of the labor market. So here in blue, we're showing the total number of job openings relative to unemployed persons. At one point, this was over 2 to 1, and that implies that for every single unemployed person that may want a job, there were 2 open positions available to that person. That is the tightest labor market that we maybe have ever seen. Now today it stands at about 1.3 to 1, which is closer to normal, but not yet fully back to imbalance. So what we can say is that the job openings moat that we began 2023 with, that's eroded quite a bit throughout the year. And when this gets back to one or less jobs, job losers will have an increasingly difficult time in finding a new job. And at that point, recession risks probably will rise. We're not there yet, but this is something we'll monitor throughout 2024. Now, a sustained healthy employment market, that is key for spending growth. So here, what we're showing is that relationship. So in blue is the annual change in spending, and in orange is the annual change in income. Now, this serves as a reminder that if the American consumer doesn't really change their savings habits drastically, which they often don't, as income rises, so does spending. So for now, both of these series are tracking about 2% growth after stripping out inflation effects, and that's pretty strong trends. Now, this is important because the change in spending is roughly 70% of the change in economic growth. Here we're showing real economic growth in blue and the growth in real consumption expenditures in orange. Now it's 70% of the economy, but it has an 80% correlation. So service spending is pretty important for economic activity at large. And it's very difficult to derail service spending without some sort of external shock. Services spending is a lot more resilient than the manufacturing cycle. And that's one of the things that makes the US economy resilient in comparison to other developed international economies. Now, we think a lot of the factors that help support a relatively stronger economy in 2023, those have weakened, but they're still present. And as it stands right now, 2024 recession calls are probably premature unless we start to get some softening in the actual hard employment data. So we'll be on the lookout for that. Now, the last thing that economists broadly missed was a fiscal thrust that largely offset tighter monetary policy. So let's talk about what we mean by that. So the top clip of this chart shows the year-to-year change in the money supply, which is influenced strongly by the Fed policy mix, both higher rates and the Fed's been rolling off their balance sheet. And those things are influencing the money supply. So we can see that Fed policy has been historically tight. But in the next clip in orange, we show federal expenditures. Now, these have come off lately, but at their peak, we're up about 10% year on year. And that happened near the worst point of monetary tightening. So fiscal expenditures were coming up, largely offsetting the tighter monetary conditions. And that was mainly due to programs like Social Security that had automatic inflation stabilizers. Now, at the same time, tax revenue was down a lot, which typically happens around bear markets like we saw in 2022. So the net effect of the fiscal was that there was a positive fiscal thrust that largely offset the monetary tightening. Now, as we look ahead to 2024, we think that the fiscal thrust may actually go the other way. There isn't that much in the way of new stimulative spending that's planned right now, and tax revenues should revert higher since you've had a bull market in asset prices this year. So a big question is, can monetary policy ease and offset a fiscal drag? So that would be the opposite condition of what we saw this year. So what we're showing here is the bond market's interpretation of what Fed policy is likely to look like for 2024. And as you can see, the bond market is now pricing in about 1% of interest rate cuts to the Fed policy rate next year. Now, it's possible that if inflation continues to improve and there's a little softening in the economic data, the Fed may actually cut rates a bit. Now, we think there are good reasons to believe that if rates were to, in fact, fall next year, that could go a long way towards spurring demand in several economic sectors that have been hurt by higher interest rates. So one of the most significant responses to lower rates could come from the housing sector. So here we're showing housing starts in blue in the upper clip. And in the lower clip, we're showing the 30-year mortgage rate. When mortgage rates are rising, that clearly puts downward pressure on new housing units. But when rates are falling, new units tend to pick up. Note that the rise in interest rates almost perfectly coincided with the top in starts this cycle. Now, we don't think mortgage rates need to go all the way back down to 3% to see a pickup in development. And importantly, a pickup in those existing home listings. Historically, it's taken about a 75 basis point to 1% drop in interest rates to make a really big impact. Now, as we turn to our market outlook for next year, it helps to frame whether or not the market is extremely overbought or extremely oversold, or neither of those conditions. And we can do that in a number of ways, and we can reach somewhat different conclusions based on what we look at. But here's one really simple method. In the top clip in blue, we're showing the S&P 500 all the way back to 1925. Now, we adjust the index for inflation and also include the impact of reinvesting dividends. Now, the orange line is the historic trend when we remove that volatility of bull and bear markets. We can see that the market has returned about 6.8% net of inflation, and that's been a real rate of return for almost 100 years of data. Now, the orange line in the bottom clip measures how far away we are from that 6.8% real rate of return. Note that we're pretty close to right on top of it right now. So that means that we're entering 2024 from actually a pretty normal place for share prices. Now, we've heard analysts call the stock market a bubble, and we simply just don't think that the data supports that conclusion. Now, it's true that a small group of very large stocks have had some really outsized returns in 2023. But thus far, the fundamentals have largely justified their run-up. So here in this chart, we're aggregating the forward earnings for the so-called Elite 8. And that's comprised of Meta, Amazon, Netflix, Microsoft, Apple, Google, NVIDIA, and Tesla. Now, earnings estimates for those 8 stocks are plotted in blue. In orange, we're showing the blended earnings estimate for all 500 of the S&P 500 companies. Now, note throughout the year that this so-called Elite 8 have really separated themselves from an earnings perspective. Now, I can't tell you with perfect foresight whether this trend will continue into 2024, but clearly the strong market run for this segment of stocks has thus far been at least somewhat justified by the fundamentals. And I think that differs a lot from something like we saw from the tech bubble in 2000. Now, I think a better question we'll want to answer in 2024 is, can the average stock start to play catch up to these so-called tech titans? Now, in 2022, we had a bear market where those big tech stocks caught down to the average stock. They had really, really bad years in 2022. A more bullish condition would be if those big companies still performed well next year, but the smaller companies start to play catch up. And we think that's possible, that the mega caps do have another decent year in them. And this chart shows that the performance of 6 of those names are here in blue. And note that even though this year has been good for them, they really have only just recovered their 2022 losses. Now, at the same time, the other 494 stocks in the index, those combined, they've only just really been playing catch up as well, and they've lagged the big mega caps for some time. So what we want to see next year, a question that we want answered, is can the stock market broaden? Can the average stocks start to play catch up? And that would be a bullish condition for next year and give us greater conviction that the bull market has more room to run throughout the year. Now, as for what can get the average stock going, we're going to look to interest rates. I think one catalyst would, in fact, be falling interest rates. And sorry that kind of this graphic is blocking out the chart here, but to kind of walk you through our thoughts here, the average stock really hasn't done as well as the cap-weighted indices. and it looks nothing like what the tech titans have been doing or the tech heavy NASDAQ. But that's likely due to this higher interest rate environment. Higher rates are more damaging to smaller companies than they are to the biggest companies. So in the bottom cliff, what we're trying to plot is the 6-month change in interest rates. And what you're seeing here in these numbers is the effect that interest rates have had on the average stock in the market. Historically, the average stock has gained about 2% per annum when interest rates are stable. Now, that's where we are now, and that's not great returns, but that's much better than the nearly 10% losses that the average stock has had when interest rates are moving higher. But take a look at what happens to the average stock when interest rates are falling. The gain has been 13% per annum. Now, that might not sound too incredible, but remember, this is for the average stock. So if the Fed loosened monetary policy, I do think that could go a long way toward improving the outlook for smaller companies next year. So let's talk a little bit more about the impact from Fed policy directly on the market. So here we're showing what has historically happened for stocks after the last rate hike in a tightening cycle. So the dark blue line is the average of all tightening cycles. The red line is the last rate hike here when the economy has moved into a hard landing. So when we've gone into recession soon after the last rate hike. And this light blue line, that's the average of the 3 cycles where the Fed successfully landed the plane. Those are those so-called soft landing scenarios. Now, the orange line is the current case, assuming that July was the last interest rate hike. Note that there's a pretty meaningful difference in returns between the soft landings and the hard landings. So this has sort of just been a long-winded way of saying that it's as simple as the economic trajectory. If we can avoid a recession in 2024, history says that the market could have another positive year despite the tightening that occurred in 2023. Now, that would become a lot more difficult if economic activity begins to contract. So finally, it would be difficult to frame any sort of outlook for next year without talking about the elephant in the room, which is the upcoming election. So first and foremost, election years do tend to be volatile in the first half of the year. As 2024 progresses, we'll have more commentary about specific policy mix and whether it will impact various market segments. But from a broad market perspective, the good news is that the range of market outcomes when the incumbent has been a Democrat has been more narrow than when the incumbent has been a Republican. So what we're showing here on this chart, the black line shows the stock market pattern for all election years. Notice that there's been a slight downward bias in the first half of the year, but then trends have picked up in the second half. The solid blue line shows the pattern when the incumbent party was a Democrat and the Democrat candidate goes on to win the election. Now, the market has been a little higher than the average year when that's happened. When the incumbent Democrat party has lost, the market has finished the year a little bit lower than average. So no doubt that politics will be a big storyline in 2024. It will play a role in some volatility for the market action next year. But if history is a guide, that role will be somewhat muted. So as we think about our recap of 2023, we would certainly note that economists and strategists were pessimistic headed into the year. We took the other side of that bet in our outlook 12 months ago. And in fact, the economy and stocks both surprised greatly to the upside. Now, as we think about economic trends for 2024, we need to consider that this year's economic moats have seen some erosion. But for now, high incomes remain supportive of continued economic growth. Rather than a positive fiscal thrust next year, we do expect a modest fiscal tightening. Now, if that can be offset with looser monetary policy, we can continue to see a broadly positive backdrop for the economy and investment markets. If monetary conditions do not ease, then the recession odds would likely go up. Now, as for our stock market outlook, contrary to some of the popular chatter that I've seen, we don't think that there is anything really extreme about the stock market right now. Some mega cap companies have had strong rallies, but that's thus far been supported by their improvement in the fundamentals. The bullish setup for next year would be if the average stock could start to play catch up. Lower rates could go a long way towards supporting that trend. So with that, that is our prepared remarks for today. If you would like us to follow up on any questions that you may have from the content today, please let us know. You can email me directly at tony.welch@signaturefd.com. And with that, I would like to thank all of you for calling in along the way this year. I wish everybody on the call a happy holiday. Thank you very much.